It is a pleasure to be with you this afternoon. I know this is probably a little bit different than the presentations that you've had throughout the day today and will have tomorrow. But the new tax law has significant challenges for us and significant impacts for farmers and ranchers. And that's what we're going to talk about in the next hour. And they tell me that I can actually go until 4 p.m. And so we'll take it right up to 4 p.m. This presentation would normally take me about 4 hours to get through. So this is the truncated version, and I probably still won't get through all of that. A lot of probably what you're thinking about, and I'll get into this in detail, is how that new 20% pass-through qualified business income deduction might apply to you. How does that apply to a ranching operation? How does that apply to a farming operation? How does that apply, if at all, to capital gain income? And I'll show you that, in fact, it does not apply to capital gain, any type of income that's taxed as capital gain. So we're going to get into that. I'll talk about the depreciation changes, meals and lodging issues for farming corporations. That ballgame has changed too. Here is my contact information, and we will make the slides. I'll have Tatum make the slides available to all of you in case you're interested in following up on this or taking them to your practitioner when it comes time to do your tax return later in the year, or even to start to do some planning. If you haven't done so already, that needs to be done. And we still don't have some guidance in some areas that we would like to have guidance in. And so that is a problem. Just about 10 days ago, 2 weeks ago, we got 184 pages of regulations on just the new pass-through QBI deduction, that 20% pass-through. And we still have some questions about that. I'll be writing some testimony for use on Capitol Hill with respect to the public hearing on that that's coming up in October. But let me just take a brief moment and summarize. If you're not familiar with my website, the Washburn Agricultural Law and Tax Report, I would encourage you to go there. Again, the website address is just washburnlaw.edu/Walter, W-A-L-T-R. And you'll find a lot of information on that from that homepage that you can access once you get there. Case annotations, and you can access my blog from that page. And you can even sign up for an email notification when I add something new to the blog. Also, you'll find archived on there all of the radio and TV podcasts. After I've done a program, if you haven't caught it live, then they're captured in a podcast and put on the website. And so you can kind of see a summary of what each one of those is like, and then click on and listen to the ones that you're interested in. I did a special one from the vehicle actually on the way here this morning on RFD TV about agricultural businesses hiring immigrants. Of course, the problem in Iowa is a big issue right now, as it turned out that the individual that's alleged to have committed the murder of Molly Tibbetts was not hired legally. That has significant ramifications potentially for that farming operation. So today's program dealt with what do you need to do as an agricultural employer to make sure that you've checked all the boxes and done your due diligence to make sure those that are working for you are legally in the United States and eligible to work on your farm or ranch. A very, very important issue in agriculture. It's things like that that my weekly program on RFD TV I deal with. Plus you have access, ordering information to my books on there and various other articles that are there. So I would encourage you to take a look at that. So let's jump into the new tax law. I know you don't have information in front of you concerning this, but you will have the slides after the fact. So let me just kind of take you through the boiled down version of this. And what this first slide shows you is in two sets here. Current law, as I'm using it here, is 2017. So current law as was used to file the returns for 2017 that were filed in 2018 earlier this year. That's the top blue line in each of the three sets of lines. The bottom blue line in each set, so, oops, let me go back. This line here on each of these, the top one is the old law. I guess we can change that to old law now. This is new law, and these are the rate brackets, and this shows you income levels down here. In between, I have it green or red or white. What green means is that just looking at the rate, under the new law, your rate is lower than it was under the old law. So there's very little, I have to get used to this advancer. Okay, let's try and go back here. All right. So your new rate is lower than your old rate for all of this income up to about $400,000. Then there's a little sliver where it turns red, and you can see the 35% rate bracket cuts into what was some of the old 34%, so now your rate is higher, then it evens out at 35, and then it's lower the rest of the way out. That's married filing jointly. If you're a single filer, there's a lot more red. So you'll notice under the new law, if you're single, you're not as well favored, and so you want to have your taxable income land in areas that are either on the low side of the red ranges or on the top side. Now there's a little sliver of green in here if you can hit that magic spot here, but basically anywhere from about 175 to 410,000 as a single filer, your rates are higher under the new law. Now this is just looking at the rate brackets by themselves. That's not taking into account the enhanced child tax credits, not taking into account any other factors that a particular taxpayer might have. It's just looking strictly at the rates. And so from a planning standpoint, we want to make sure clients, to the extent we can use tax planning mechanisms, don't land in a red area. Now, there's another change in the law known as the P's limitation, and this was what was happening to higher income individuals. They were losing itemized deductions as their income went up. And so that was known as the P's limitation. That's been repealed under the TCJA, the Tax Cuts and Jobs Act. So basically, that's an additional tax cut for higher income earners. It used to be effectively about a 1 to 1.2% surtax on higher income earners. Now, all of this, or many of these provisions that I'm going to talk about this afternoon, are temporary. So this is something that might come back if the law does actually sunset after 2025. So when you look at the charts with the P's limitation removed, married filing jointly, you're always better off on the rates. Low to high income, your rates are always lower once the P's limitation is removed, but not so for single individuals. That's still a significant amount of red area for single individuals, new law compared to old law. Okay, for estates and trusts, if you're dealing with a family member's estate or you have a trust and the estate or the trust generates income, look at the tax brackets that apply to estates and trusts. This is no change from prior law, but what this points out is something that many people don't understand, and that is the tax brackets for estates and trusts are very compressed. You're going to hit that top end on a trust or an estate at $12,500 of taxable income, and then you're at 37% every dollar after that. 37 cents on the dollar is taxed. So we don't, from a planning standpoint, we don't want to have income taxed at an estate or a trust level to the extent we can avoid it. We want that kicked out, taxed at the beneficiary level, which is likely to be much lower than 37%. There's a big planning point with respect to that. Capital gains, no changes. TCJA did not change capital gain tax rates at all. There still is the possibility of getting a 0% capital gain rate for those whose taxable income, regular income, is in a low bracket. Some will be taxed at 15%, some will be taxed at 20%. Then, of course, under Obamacare, you have the additional 3.8% tack on for passive sources of gain. So if you have investment type income, income from a business that generates capital gain in which you are not materially participating, that'll generate a passive gain to you. That's taxed at an additional 3.8%. So 15 goes to 18.8, 20 goes to 23.8. That didn't change under the TCJA. AMT, I think for farmers and ranchers, because of the increase in the threshold for the application of the alternative minimum tax, plus the significant increase in the phase-out range, I think for all practical purposes for farmers and ranchers, the alternative minimum tax is gone. That's that additional calculation that some taxpayers, and about 35 million taxpayers, individuals, had to do under prior law. You calculate your regular tax liability, then you'd remove all your deductible items, or many of them, state and local taxes, for example, and medical expenses and all of that, and then redo your computation, and you'd pay the tax rate, the tax amount that was higher on your two computations. That, because of the increase in the exemption and the increase in the phase-out range, I think for all practical purposes, AMT is effectively eliminated for farmers and ranchers. Now, the corporate AMT is gone. They just repeal it for corporations. They did not repeal it for individuals, but the practical aspect of it is that it is repealed. Kiddie tax. This one is very important for farmers and ranchers. A lot of you do this. What is the kiddie tax? Well, under the old law, kids under 19 or a full-time student under age 24 were taxed at their individual tax brackets on their earned income, but unearned income above a threshold of $2,100 last year was added to their parents' income and was taxed at the parents' rate, which was likely much higher than the child's rate. New law is that the child's unearned income is subject to the trust tax rates on unearned income, which is going to hit 37% at $12,500. Now, what does that mean? That means if you're gifting grain to your kids, commodity gifts, much more likely that you're going to walk yourself right into a big tax increase, because once the kid's unearned income gets over $12,500, they're in a 37% tax bracket. It's taxed at 37 cents on the dollar. So if we've got families that are doing large grain gifts, for example, any type of gifts in commodities, could be a side of beef, could be grain. Once you get up above $12,500, that's taxed at 37%. So we've had to get families to back off of that, reconsider other options. You'll still save self-employment tax. That's still there because it's not a sale. You've gifted the commodity to the child. But if it's significant enough, then your increase in the tax rate, given that it's going to be 37%, will at some point start to outstrip the 15.3% saving that you're going to save on avoiding self-employment tax. That's one of those that you need to talk to your tax practitioners about. If you're utilizing a strategy of gifting commodities to kids, you might walk yourself into a $4,000 or $5,000 or $6,000 tax increase this year if you haven't planned for that. Now again, remember, you still do save SE tax, so this is a problem for those that are engaged in large-scale grain gifts. Okay. Adjustments for inflation, just a quick one here. What you're going to see as we go through these next 6-7 years under TCJA is that the inflation adjustments will not seem to be as much as they've been in the past. And that will be exactly correct. They will not be as much as in the past because now the federal government is changing the inflation adjuster. They're using what's known as the chain CPI. And basically what that will amount to is a less of an increase for a given amount of inflation. Over 10 years, the estimated effect is this will be around 3 percentage points. It's an indirect tax increase. It's kind of a hidden tax increase. That's the way it was scored by the Congressional Budget Office. It's scored as a revenue raiser. It's an offset provision. But that is a change. We will not see the same level of inflation adjusters, which means your bracket, you'll have a little bit more bracket creep. The bracket ranges will not increase as much as they've done in the past. Other adjustments will not be as high as they've been in the past. Repeal of the individual mandate under Obamacare, under the health care law. I call this the Roberts tax, after Chief Justice Roberts, who twisted the law, in my view, to uphold the entire health care law by saying that the individual mandate was a tax and therefore it was within the congressional taxing power under the Constitution, which made the whole law constitutional. Well, in his honor, I call the penalty tax for not having the government-mandated health care the Roberts tax. That is repealed, but not until next year. Make sure you're clear on that. There still is the obligation to prove on your tax return that you have an acceptable level of government-approved health insurance to avoid paying this penalty tax. That goes away starting in 19. Now, there have been some misreporting of this. Politicians and the media and even the president have said, well, we repealed it. Yes, it is repealed, but not this year. There still is that obligation this year in 2018. But that's just on the individual side there. You see with respect to the one that applies to employers, large employers, that one was not repealed. Above the line deductions, a lot of those are gone. A lot of the deductions, I think far fewer individuals are going to file a Schedule A. Far fewer people are going to itemize deductions because a lot of those have been eliminated in return for a much higher standard deduction. The standard deduction roughly around $24,000 for a married filing joint couple. And so if you don't have itemized deductions on Schedule A that would exceed $24,000, you're not going to file a Schedule A. You're not going to itemize. That's going to be a change for some people. Well, what's been eliminated? The alimony deduction starting next year is gone. And in fact, the tax treatment of alimony is flipped around 180 degrees. You can see here that alimony payments will not be deductible starting next year, and there's also no inclusion of the alimony in the hands of the recipient spouse for tax purposes starting next year. So that is 180 degrees different. We used to get a deduction and included in income. Now there's no deduction and no inclusion in income starting next year. One provision that's very popular I don't have it on the screen here. I'll come to it later. I've been asked many times, well, what about the ability to donate directly from an IRA to a charity for an individual that's over age 70 and a half? Has that changed? No, that has not changed. That still is a very popular provision that's still very much available. But the rule permitting contributions to a non-Roth IRA to be recharacterized as a contribution to a Roth, that one was repealed. So you want to talk to your financial advisors about that. The Roth recharacterization rule has been changed. Rollover of plan loans, I think I'll skip that one in the interest of time. Student loans, if they're discharged due to death or disability, that's now no longer treated as a taxable income. Although I'm not sure you want to die or become disabled, just so you can exclude that from income, but that is the change on that one. Moving expenses, this is a biggie. Deduction for moving expenses, as well as the exclusion of qualified moving expense reimbursements, is suspended. In other words, you don't get that for years 2018 to 2025. The only exception is for military that move pursuant to military orders. They're on active duty and they move pursuant to military orders. They can still deduct their moving expenses. Other taxpayers cannot through 2025. Okay, I'll skip that. A lot of the same things for students stay the same. Really no changes there. Is anybody using 529 plans? Okay. Not used as much as we would like. It's very beneficial, particularly if you have a grandchild. You can put up to $10,000 per donee, so per grandchild, to pay tuition for enrollment or attendance at public, private, or religious elementary or secondary schools. They've really expanded the opportunities to use these tax-favored, what are called Section 529 plans. That $10,000 is on a per-student basis. The standard deduction, the old was married filing jointly, $13,000. The new one is $24,000. This is in exchange for eliminating a lot of the itemized deductions. Now the standard deduction is much higher. That will sunset after 2025. So I get asked a lot of questions about, well, what's my zero tax amount now? How much is the threshold of income before we would even have to file? That goes up to in 2018, $24,000 on a married filing joint return. Last year, the zero tax line was at $20,800. So now more people, that's a significant increase. That's almost a 20% increase in the zero tax line. So if you're under that line, there is no tax, and there would, in many instances, not be a filing requirement. And this is just a bar graph that shows blue compared to gold. The blue is the old standard deduction, and combined with the personal exemption. The new gold one is the $24,000 standard deduction. So the new one doesn't depend on filing status. The new one is much, well, not much, but it is higher than the old combined standard deduction personal exemption. Okay, we'll skip that. This is just a refresher on deductions versus credits. Deductions reduce taxable income. Credits reduce the tax payable, so the value of a credit is dollar per dollar of reduction of tax. And that, obviously, credits are much more powerful than our deductions. So the child tax credit, very big one, child tax credit is now doubled. So going from $1,000 to $2,000 per child under age 17 as of the end of the year, with $1,400 or 70% of that refundable. Meaning if you don't have the tax liability to be able to use the credit, the government writes you a check. So that is significant. That used to be $1,000. I've always felt ripped off by this. I've told my wife this. You know, our kids are of such an age where didn't get to use hardly any child tax credit. There wasn't a child tax credit for our daughter for many years. And then our son came along, and we got to use a little bit of the child tax credit because they kept the phase out so low, we'd get phased out on it. Didn't really get any benefit. Now they're well over 17, and now the credit's doubled, and the phase outs have gone way up on this. So a lot more people are going to be able to use the child tax credit. So for individuals, I guess an incentive this year would be to get married, because you would have much far fewer of the red zone. Remember that graph? So get married, have kids, and get a divorce. All in 2018. That's what this is. That's what you can. That might be the take home from this. You want to talk that tax planning move over with your spouse, of course. You have to have a Social Security number, get this, to claim the child tax credit, but you don't have to have a Social Security number to claim the new non-child dependent credit. Say, well, what's that? They added in, not only did they double the child tax credit, but they added in a $500 credit for a non-child dependent. such as a grandparent, for example. Children over 17. So you don't get a $2,000 child credit, but if they're still in your basement at 30 years of age, you get a $500 credit. All right? That one's not refundable. Okay, so think that one through. After 2025, all of this reverts back to the old provision, so the child tax credit goes down to $1,000, the non-child dependent tax credit goes away, and we just go back to where we were in 2017. Okay, and those were the phase-outs. Medical expenses. For 2017 and 18, the threshold is now 7.5% of AGI, where it used to be for mto years. Under Obamacare, that went to 10% before you get a deduction on your Schedule A for medical expenses. You had to clear 10% of AGI. Now it goes to 7.5% for 17 and 18. For 19, it's going to go back to 10%. So that's a little weird one. These miscellaneous itemized deductions. State and local taxes used to be able to deduct property and either state sales tax or state income tax. The new one, and this has received a lot of press attention, a lot of controversy, a lot of confusion. You got a $10,000 limit on the SALT taxes, state and local taxes. And we've got the high tax state governors that are all upset about this, and they're trying to come up with ways to get around this rule, and the IRS is saying, no, you can't do that. This is a matter of federal law. States have no right to pass legislation saying that this is a charitable gift to the state, and so you can write it off that way. It doesn't work that way. But it's $10,000 combined for property or income sales taxes. But if they're taxes associated with COTB, that's carrying on a trade or business. If the property taxes are associated with property you use in your business, there is no $10,000 limit. Okay? So for your land, your property taxes associated with your land used in your farming or ranching operation, that is not subject to the $10,000 limitation. There's no change on that. You continue to write that off. This only applies to property that's not used in your trade or business, so keep that in mind. Mortgage interest, they've changed the deductibility of interest associated with a mortgage to the first $750,000 of the loan rather than $1 million. That doesn't really apply to very many of us in agriculture or in the plains or the Midwest at all. Charitable provisions, a little change here. You were limited under prior law to 50% of your contribution base. So how much could you give to a charity, a qualified charity, and deduct? Well, if your contribution base was $200,000, you were limited in a year to 50% of that, or $100,000, then you'd have a carryover to the subsequent year subject to the same limitation. 50% goes to 60% for qualified charities such as churches, for example, with the disallowed amount carried forward five years and then subject to the limitation in the carry forward years. They've repealed the special rule for deduction for 80% of rights to buy tickets at athletic events. That applies to some people, but there are some strategies around that. Casualty and theft losses, there's some changes here that affect this. We'll get to another ag rule in just a moment when I turn this to ag specific. You can claim personal casualty losses only if the loss is attributable to a federally declared disaster area, and that's a big issue for ag. You can still offset personal casualty losses that are not attributable to a federally declared disaster against personal casualty gains to the extent the losses do not exceed the gains. Various itemized deductions are suspended. Employee business expenses, we can't deduct tax prep fees going forward. Investment interest expense, we talked about the personal casualty and theft loss and mentioned the ones that are modified, particularly the charitable one. They've made some changes with respect to gambling losses also. Net disaster losses, if they're incurred for 16 or 17, it's deductible, regardless of whether the aggregate net losses exceed 10% of AGI, as long as each casualty exceeds $500. ABLE accounts, I think I'll skip that. That's a special type of basically IRA for a disabled beneficiary. They're very useful. I think they're underused, but there is a special rule that's out there if you create basically an IRA for a disabled beneficiary to get a tax break in doing so and benefit the beneficiary. Now, the ag-specific provisions. Commodity gifting, I discussed earlier, the deduction for state and local taxes. We've talked about that limitation of $10,000 of itemized deduction of property taxes does not apply to property tax related to the farm business. I've got numerous examples we could show you with respect to that, but I'll skip those in the interest of time for us today, too. Losses. they've changed the excess farm loss rule that came in the 2008 Farm Bill. This is a big issue for agriculture, and the computation, the way this is computed in what are known as the carry forward years is important to us also. You've got an overall limitation on the deductibility of losses associated with your business. If you're not a C corporation, this is for non-corporate taxpayers, there's a different rule for corporations, to $500,000 on a married filing joint return, $250,000 for every other filing status, single, head of household, so forth, so on. That is indexed, subject to the change CPI. It applies if you have a partnership at the partner level. If you have an S corporation, it applies at the S corporation shareholder level, with the excess disallowed by the limit. So if you get caught by the $500,000 limit, you have a bad year, you get big losses, the excess is not lost, it's carried forward, and it's treated part of your NOL carry forward in the carry forward years, the subsequent years. And then in those, they've changed the percentage deductibility of a net operating loss going forward. So the NOL deduction is limited to the lesser of the carryover amount, or 80% of your taxable income determined without regard to the NOL deduction. So NOLs are not as valuable as they were in the past. We've got a $500,000 limitation, a carry forward rule which limits the amount to 80% of taxable income in the carry forward year. Your pre-2018 NOLs that were subject to carry forward, so let's say you had a 2017 net operating loss, you carried forward into 18 and then 19, are not subject to this rule. They're still allowed in full. It's just your 18 and forward losses are going to be limited to 80% of your taxable income. Now, they've changed the carry forward and carry back rules. In agriculture, we've been used to a 5-year or 2-year carry back. We could have a 2-year carryback rule, or we could elect to carry back the NOL 5 years and offset income in that 5-year tax year prior to the current year. That rule's gone. Agriculture can go back 2 years on an NOL. Nobody else can carry back a net operating loss. That is ag specific. The carry forward is no longer limited to 20 years. I've got an unlimited number of years I can carry forward a net operating loss. So ag gets to go back 2, nobody else can go back, and we can go forward indefinitely. Okay? Now there's some question in the carry forward years as to what the definition of taxable income is. We're trying to get the tax writing committees to figure that out in a technical corrections bill. So let me give you an example of this. Let's say Bill is a single farmer or rancher and shows a Schedule F loss of $750,000 this year. He's single, so what's his limit? $250,000 is his limit, right. So his excess business loss is $500,000, which he can carry forward as an NOL. So the $250,000 loss is allowed in 2018. That then creates a farm NOL that he can carry back if he wishes, or carry forward if he elects. Carrying back is automatic. That will automatically happen. You can forego the carryback and make an election on the return to carry it forward. That's how that works. So, just whatever your tax plan indicates is the best thing to do. So let's say in 19, Bill's taxable income before the NOL, good year, he now has $450,000. So just play along with me here. This is fictitious. Okay? The NOL carry forward can offset the smaller of the NOL amount, or 80% of taxable income for the year. So his income offset would be $500,000, which he carried forward, or 80% of his taxable income, 80% of $450,000. The minimum of that, it's the smaller of those two, is either $500,000 or $360,000. And if you're good at math, the smaller of those two is $360,000. And he still has some that's unused that carries forward to the next year. So he started at $750,000, he took $250,000, carried forward $500,000, he now takes $360,000 of that. He still has some left. You carry forward, same computation the next year. That's how your NOLs will work now. The point is, it's going to take you longer to use up an NOL than it did in the past because of that 80% limitation that's there. So NOLs are not as valuable as they have been in the past. They're still useful, but they're not as valuable. So we don't want NOLs. If possible, there are some things we can suggest that you do. You also have to take a look at state taxes if you're in a state that has taxes too. Business interest going forward. There's an application here to ag, and the application could hit cattle feeders you're going to have to pay attention to this one. The big cattle feeders, the feedlots, there's a special rule that was put in specifically for them because of their business model. The business interest deductibility might be limited to business income plus 30% of your adjusted gross income. Business interest has always been fully deductible. That changed under TCJA starting in 2018. You might be subject to a rule that's going to limit it to your business income plus 30% of your AGI. Now, that's determined at the tax filer level except for pass-through entities with the excess being carried forward. If you're entitled to use cash accounting, then that 30% limit does not come into play. So there's two things that are working together here. What do you mean entitled to use cash accounting? If your annual gross receipts do not exceed $25 million for the three prior tax years, which is then indexed after 2018, you are entitled to use cash accounting, and there's no limit on your deductibility of business interest. Now, for most farming or ranching operations, there's no change on the deductibility of business interest. What I'm saying here is that the large cattle feeding operations will exceed the $25 million in many instances and then potentially be subject to a limitation on deducting interest. Cattle feeding is a very highly leveraged industry, and they were concerned about this. I got calls initially last fall when they saw the drafts of this. So we put our heads together and we got an exception included for agriculture, and particularly it's the cattle feeding business. Farm businesses over the limit, engaged in farming or ranching, so cattle feeding would count, can make an election out of the 30% limitation. Normally they'd be out, they couldn't use cash accounting, now they'd be subject to the limitation on deducting business interest, but by an exception you can elect out. The price that you pay for electing out is that your depreciation is going to get slowed down. Some of you might have been ranching long enough that you remember 30 years ago, 32 years ago, we went through the repeal of the heifer tax. Anybody here remember that at all? Livestock used to be subject to the uniform capitalization rules. So as you were raising livestock, you couldn't deduct the costs of raising the livestock. Ranchers didn't like that, and so Congress created an exception, but the exception was, okay, livestock is out, plants are still subject to the uniform capitalization rules, but we're going to slow your depreciation down to the 150% declining balance method. Non-farm property gets 200%. So twice the straight line, ag gets 1.5 the straight line method. Okay, that's kind of what's happening here. If you find yourself subject to not being able to use cash accounting, you elect out, then your depreciation is going to slow down. The kicker here is, and you can see the type of assets that get slowed down and has to use alternative depreciation. The kicker is you can't use bonus. Bonus is now 100%. So we get 100% write-off on just about every farm asset. You go buy a combine, you go buy a tractor, take 100% of it, write it off. That may or may not be your best tax strategy, and you need to talk to your tax planners in terms of what your strategy would be, but you can do it. If you have to elect out, maybe because you're a large cattle feeder, now you can't use bonus depreciation. That's a big penalty when that's 100%. You can still use expense method depreciation, I'll talk about that in a moment, and that ceiling has gone up too, but you can't get 100% write-off on your qualified assets. So just be aware of that one. Okay, so there are some planning strategies involved. Fringe benefits. If I've got a farm corporation, can I provide fringe benefits? Well, because Congress dropped the corporate tax rate down to a flat 21%, the price that corporations pay is they give up a lot of fringe benefits. The tax benefits, the tax deduction associated with the fringe benefit. For example, employer-provided meals, instead of being 100% deductible, they're going to be 50% deductible through 2025, and then it goes to zero. And we just won a major tax court case last year against the IRS on the 100% issue, and now it's gone. So it's 50% deductibility on meals provided to employees that work for your farming and ranching operation that are provided at at the employer's convenience on the business premises. Okay? All right. But again, that crashes to zero after 2025. Depreciation changes are big too. Look at this. 5-year recovery period for machinery or equipment other than grain bins and cotton ginning assets and fences and other land improvements. But you get 5 years on your farm machinery or equipment, okay, used in the farming business, the original use of which commences with the taxpayer after 2017. Note the italicized language. New farm machinery and equipment is 5-year maker's property. You depreciate that over 5 years. Normally, what would have that been? What was that? 7 years. Now that goes to 5. New is 5. Used farm machinery and equipment is what? Stays at 7. Oh, great. I got some machinery that's going to be 7, some machinery that's 5. If the state has a tax system, the state may or may not couple with what the feds just did. This depreciation now becomes a very big nightmare for your tax practitioner. If you're trying to do it yourself, stop. Don't. I would suggest don't. This is so messy now. 5 years on new machinery and equipment, 7 years on used machinery and equipment, and the 200% declining balance method that came into play when they repealed the heifer tax, that's now gone. We flipped that around. We're back to 150% on most of your farm property, with the exceptions noted on the slide. So 5 on new, 7 on used farm machinery and equipment, back to 200% declining balance method on most farm property. So they speed it up and then change some of the rules. All right, this is just to keep us on our toes. While this was happening, just a side note, while this was happening this spring, I teach farm income tax at the law school. And of course, we get a brand new tax system. They overhauled the whole tax code. I had already set the course and had it ready to go in December, and here comes the tax change. It was signed into law on December 18. I got to redo the whole thing while we start the course in January. And of course, the 199A deduction had to be redone because of the co-op issue, and that didn't get finished until March. From a student standpoint, the students that are in my law school course taking farm income tax, they don't know the difference because they have nothing to base the past on. They think, okay, this is the tax code, I have to learn the tax code. I have to unlearn a tax code and learn a new tax code and disabuse myself of what I've learned the past 25, 30 years and start over. So actually, they had it better off than I did. I'm trying to teach this as we're trying to get information out of the Treasury as we're going through. So it was tough this spring. But I did manage to come up with a 100-question, 6-day final examination for them. So good. All right. All right, I'll skip plants. You're probably not interested in plants. Let's go to section 179. 179 goes to $1 million. How many of you remember when that was $3,000? Now it's $1 million. Never thought I'd see this go to $1 million. A lot of farm property now where we can just 179 it up to $1 million. The phase out starts at $2.5 million. It's still a dollar for dollar phase out once you get above $2.5 million. So at $3.5 million of qualified asset purchases, you're phased out on your 179 that you can claim. They've also added a couple categories of properties that are not really non-ag. But the point is you can elect out of bonus depreciation and optimize your income by using a specified amount of Section 179. Now, bonus is automatic if you qualify, and you have to make an election out of it, and then you can optimize your income by using and selecting a set amount of Section 179. This is going to phase down in the out years. Bonus depreciation will. So I've switched back to bonus now just by comparison. It's 100% through 2022. Then it goes to 80, 60, 40, 20, and then supposedly it's going to be gone after 2026. Now, Congress could change all of this before we get there, and they probably will, just so we don't get comfortable with these things. But that's what bonus is doing. So we've got 179, that's how much right now? $1 million. Bonus is 100%, okay, on qualified assets. So you can do a lot with depreciation. New farm machinery and equipment, 5-year makers category. Used is 7, and on most of your farm property, you're going to get 200% depreciation. So there's a significant amount of change in tax that applies to farmers and ranchers beginning in 2018. Let me give you an example here on bonus depreciation with our taxpayers, Sam and Sue Flay. They're chefs, let's say, but they also operate a farm. And the farm income is $300,000, and they bought $400,000 of new equipment, say in 2018. So on the left-hand side, farm income of $300,000, 100% bonus would be $400,000. First-year depreciation is 0. because we've taken all of it off with bonus and we don't have any basis left. So the Schedule F shows a negative $100,000. You can create a loss by that bonus depreciation. On the right-hand side, let's say we elect out a bonus. And I'm trying to show you the benefit of electing out of bonus and using 179 to carve a specific amount of income. So we've got a $100,000 loss on the Schedule F, carry forward subject to the 80% limitation that I showed you a little bit ago. But same thing on the right side of farm income of $300,000. Elect out a bonus, and let's say I want to take only $200,000 of the million of 179. Then that leaves some depreciation that I can depreciate out under whatever my property is, 5-year, 7-year, 10-year property. Let's say I have $40,000 depreciation. Now my Schedule F shows $60,000. So my new purchases were $400,000. I took $200,000 off of 179. My remaining cost basis is $200,000. That's where I get the first year depreciation of 40. My Schedule F is 60. I don't have a net operating loss. And that $60,000 is still taxed. If you remember the bracket cuts, what's your rate on that? 15%, okay? Because that cut level is at 77.4. That's probably a better tax strategy than creating a loss on the return and subjecting yourself to the limitation on the deductibility of losses. Okay, all right. So another example here, farmer buys $500,000 of used equipment, $350,000 of tiling. So I'm saying this is somebody that has, they're probably, far east of the 6th principal meridian, and there's plenty of water, and they have to tile the land. And they buy land with a machine shed worth $500,000. Under the old law, you'd only get 50% bonus on the tiling. That's it. Under the new law, you depreciate out everything. $1,350,000 under 100% bonus depreciation. That shows you the dramatic difference last year to this year. So tax liabilities for farmers and ranchers are going to be way down, I think, across the board in agriculture starting in 2019, primarily because of the depreciation rules. Okay, that's just a summary of where we're at. Like-kind exchange rules have changed dramatically. You can no longer get tax-deferred, like-kind, 1031 deferred tax treatment on personal property trades, tractors, combines, livestock, those types of things. You can only get it with respect to real estate. Now, that doesn't mean that the bottom line tax is going to be higher or different. It's just we're going to get there under a different path. We can still get to zero tax, but we're going to take a different road to get there. Let me show you what I'm talking about. So you can't, this is for trades that are completed after 17, personal property trades, no good anymore in terms of qualifying as a 1031 trade. Does that mean farmers and ranchers are not going to trade tractors and combines and livestock? No. Why? Because at birth, you're born with a chip in your brain that says, we trade things, right? We just trade bigger things as we get older, worth more money. Okay, so how's this going to work? Well, I'm glad you asked, because I put a slide in there in case somebody asked. Your trade-in value now becomes the selling price of the traded equipment on IRS Form 4797. So the entire asset value gets thrown on the depreciation schedule, now becomes eligible for 100% bonus as well as Section 179. So we still get our bottom line of zero, but we just got there a different way. We can't use 1031. It's not a tax-deferred exchange. It's not tax-free. But now it's thrown on the depreciation schedule, and we write it off that way, which creates another complication. So I'm kind of leading into my next topic. Will the gain reported on the Form 4797, because that's where you're throwing it now, will that be qualified business income? And the answer is it depends on what portion of the Form 4797 that gain is reported. The QBI deduction does not apply to capital gain. So the portion of that trade that is taxed at a capital gain rate will not qualify for the 20% QBI deduction. I'll have some examples on that in just a second. That's a really big issue. That is a huge issue. And I'll show you some cattle operations, breeding stock, dairy operations, where that's got a surprise if you're not aware of what's going to happen to you. So Frank Farmer, under prior law, before depreciation, his income was $250,000. He traded in a tractor. His old tractor trade allowance was $150,000, let's say. So the new tractor trade difference, the boot that's taxable, is $250,000. Okay, left-hand side is farm income. Again, to restate this, is $250,000. Let's say it has a 179 deduction of 131,053, and I'm selecting that number carefully to get a specific result. Leaving first year depreciation, let's say at 12,744. So Schedule F now shows income of 106,203. His new purchases were 250. Pull out the depreciation deduction, 131. Remaining cost, 118. At 7 years, 150% declining balance under the old law. That gets him percentage under the table is 10.74%. So his first year depreciation is 12,744. That's how I get that. You'd have nothing on the 4797. Schedule F comes over half of the SE tax, 7503. AGI is now dropped down to 98.7. Standard deduction exemptions were 21.3. Taxable income 77.4. SE tax 15. His total tax liability last year under this scenario would have been 25.6. Okay? Under the new law, presuming the same thing, look at your bottom line. Oops, and I messed this thing up. 8907. What was it under prior law? 25.6. So even though the trade rule is changed, you still can come out better. What's making up that difference? The difference on the trade, take a look at this. This is old law. What you were triggering was $15,000 of self-employment tax. That's gone because of the way we do it under the new law. There's no SE tax now because it's flipped. It's not a tax-deferred exchange. It's put on the 4797. It's theoretically subject to tax, but we wipe it out with depreciation. We wipe out the self-employment tax, dropping the tax liability down significantly. It's because the SE tax is gone that is the difference. Okay. That, when you explain it that way to people, it's one of those, that's pretty good. Even though I can't trade tractors and combines and cattle and those types of things, you still can come out ahead if you do it right. And that's the point that I wanted to make with respect to that. Okay? All right, so get your trade-in value correct. Now, let's go to the 20% pass-through deduction for non-C corporations. This is generating all the talk. A lot of farming operations and ranching operations are not conducted in the C corporate form. Many of them will be sole proprietorships, S corporations, partnerships. Can I get the new 20% QBI deduction? And the answer is maybe. And or if you sell to a co-op, how does that work? And we'll talk about that too, because co-ops can claim this and pass it through to their patrons. Okay, it's temporarily effective for tax years after 17 and before 26. The basic idea is to provide some type of parity for those that aren't operating in the C corporate form, because the C corporation's got a tax cut down to 21% at the corporate level. So the idea was, let's give a tax break to everybody else, and that came in the form of a deduction. Now, deduction's not as powerful as a credit, but if you can qualify for it, you want to be able to take advantage of it. And so you can see the type of entities there that qualify for this, and it even applies to service trader businesses. So you may be running the ranch, you may be running the farming operation, maybe you have a spouse that has a service business that they're running in town. Maybe he has a flower shop in town, or whatever the case might be. That business now might also qualify for the 20% deduction, where it did not qualify for the now repealed domestic production deduction, which was 9% for everybody except oil and gas, which was 6% through 17. Okay, so I've already kind of talked about this. It applies to taxpayers that are other than C corporations. It only applies for income tax, not SE tax, not the net investment income tax, that 3.8% amount. And it's used to arrive at taxable income, but not to arrive at AGI. Let's think about that for a moment. How many of you also have a farming operation in addition to your livestock operation? Participate in government farm programs? Okay. Let that thought sink through. Does that ring a bell with anybody right there? The QBI deduction is used or allowed to arrive at taxable income, but not to arrive at AGI. What am I driving at? This is a very important take-home point I'm coming to. This is when you have people drafting tax legislation that don't understand the implications for ag producers. Anybody catch my drift? Where am I going with this? How do you become eligible to participate in federal farm programs? What kicks you out? Too much income, and it's AGI that kicks you out. What's your threshold? Do you remember? 900,000. 900,000 AGI. You got to stay beneath that to be eligible to be in the farm programs. For person determinations, you get a payment limit of $125,000 per person. That's how you compute your eligibility, ARC, PLC payments, other types of qualified payments that will go toward that limit. Okay? Conservation Reserve Program has a separate limit, but you got to stay under 900,000 AGI. Go back and read the slide. What am I getting at? The D-pad that was repealed by the QBI deduction was on the front page of the 1040. It was part of the AGI calculation. That's now repealed, replaced with the QBI deduction, which is not part of the AGI computation. It does not show up on the front page of the 1040. It's part of the taxable income computation. Do you get where I'm going at yet? Let's say I had $1,000,001 of income last year, but I had a D-pad deduction from my co-op of $200,000. I took that off the front page of my 1040. My AGI that FSA looks at, $900,000. You're in. Same thing this year. I got $1.1 million, and I get a $200,000 QBI deduction, but it's not on the front page of the 1040. My income that for FSA purposes is $1.1 million. I'm now out. I'm not eligible for payment limits. Let that sink in. That's exactly what can happen now under the new law. It's the old 900, or the current and the old $900,000 AGI limit was computed by using the number shown at the bottom of page 1 of the 1040. That used to include the D-pad. It does not include the QBI deduction. So if you're on the cusp of the 900,000, watch out. You could be inadvertently thrown out of federal farm programs and not be eligible for any payment limits. Okay. Now, the offset to that is that your QBI deduction might be larger than your payment limits. And for some producers in some parts of the country, they would be larger than your ARC or your PLC payments. Now, that might not always be the case. Obviously, that's a case-by-case situation. But this is one of these. You got to watch that. How many of you had heard that before? Anybody? Okay. Yeah, that's worth your price of admission right there for some of you on that one. Okay, be careful with respect to that. Okay, see how, and I heard the comment here, I was just saying, you know, this has become so simple, you can just put it on a postcard.
How'd you hear that?
Yeah.
They bragged about this.
Yeah.
Down on a postcard.
It's simple. Well, you know, this is government at its best. And we can put it on a postcard, but now what do you have to do as an ag producer? We have to attach 6 schedules to our postcard. Great. Okay, I won't even bother you getting into the schedules now that have to be prepared and attached to your postcard. But nevertheless, anytime you have a business, I would, back on the postcard issue just for 30 seconds, the new law does clean it up. It's a lot simpler for individuals that just have W-2 income and have kids, so that they can take off $2,000 per kid. Because they're not going to file a Schedule A, their deductions are not going to be $24,000, and so they're just going to file the 1040 without the schedule. All they have is W-2 wage income, maybe a couple of kids. Yeah, it's much simpler for those people. Anytime you add a business, forget the postcard. It's out the window. It is more complex than it's been in the past. So for farming and ranching, no, for the vast majority of farmers and ranchers, complexity is still there. Okay, now let's get into this QBI deduction a little bit. What is qualified business? What is qualified business income and what is not? The deduction applies to business income. So there's some things that are not business income. Does not include reasonable compensation paid to, for example, an S corporation shareholder. Does not include a guaranteed payment paid to a partner in a partnership. Does not include wage income, and that includes S corporation shareholder wages. Does not include capital gain, does not include capital loss, dividends or the equivalent of dividends. Okay? Does not include any amount received from an annuity that's not in connection with a trade or business. does not include, if you're participating in the commodity markets, and if you're speculating in the commodity markets, speculative income is not business income. Speculative gain is not business income. Hedging gain is, because that's associated with offsetting price risk in your business. So hedging gain counts as business income. So these are the items that are out, okay? So let me give you an example here of a sole proprietor. Julie is a farmer and sole proprietor, Schedule F income, $150,000. I'm on the left side of the chart here. Pull out the SE tax of $99.69, so the net business income out of $150, once you pull out the SE tax, is $140. You take 20% of that, deduction is $28,000. If Julie were operating in an S corporation, filing an 1120S, look at the difference in your deduction. Schedule F, 150 again, less wages. You got to pay yourself a wage in an S corporation, or IRS is going to be all up in your business. You got to pay reasonable wages. That's not optional. Some farmers and ranchers have thought that's optional. IRS will audit that. They audit that one constantly. That's a huge issue with them. And so let's say she's paid $55,000. That's in the range $40,000 to $60,000 that we usually put farmers and ranchers at. You got to back that out. That reduces the SE tax down to $42.08, but now the net QBI is $90,000 and change. 20% of that reduces the deduction to $18,158. What's the lesson here? The entire bottom line of a sole proprietor, the bottom line of the Schedule F, is business income, and you take 20% of that. You're going to get a much larger deduction. Once you change it to an S Corp, you got to pull out the wages that are paid. That's going to reduce the deduction. It does reduce the self-employment tax by the amount of the wage that you're pulling out, but it also is going to reduce the deduction. In this instance, it's a $10,000 difference. Now, do I want to be a sole proprietor as opposed to an S Corp? There are other reasons to not be a sole proprietor, particularly legal liability issues. But what I'm showing you here is the sole proprietor gets the full benefit because the entire bottom line is business income. Okay, so that's the point that I'm making with respect to that slide. Okay, and that's the same with whether you're an F or a C. Okay, guaranteed payments. You see the same result here in a partnership. You have to back out the guaranteed payments. Capital gains don't count. So QBID cannot exceed taxable income. QBID is the qualified business income deduction. That cannot exceed the taxable income of the taxpayer in excess of the sum of the capital gain. Translation is you have to back out your capital gain income. So now let's say I've got a cow-calf operation and I sell raised breeding livestock that I've held for more than 2 years. I raised them. $300,000 gain is triggered. My ordinary income is zero. In that instance, this is all the income that I had. Farming and ranching is kind of tough times right now. I didn't make anything from my farm or ranch, but I sold raised breeding stock, and that was where all my income came from. So my ordinary income is zero. My initial QBID is 20% of my taxable income, so 20% of $300,000. I would think I'm going to get a $60,000 deduction. However, the deduction does not include capital gain. All of my income was capital gain. My deduction is zero. That's how that works. Okay, that is raised breeding livestock. Now let's say we have a cow-calf operation that sells purchased breeding stock. Different. Purchased breeding stock. I bought them 8 years ago for $200,000 and now they're fully depreciated. The sale generates $200,000 ordinary gain. Why is that ordinary? Because that's recaptured depreciation. So now I've got recaptured depreciation. Recaptured depreciation under Section 1245 is taxed as what? Ordinary income. That's not capital gain. The portion that's treated as recaptured depreciation under 1245 is taxed as ordinary income. And I've got a $100,000 capital gain. Remember, I sold them for $300,000, so I have $200,000 ordinary gain as depreciation recapture, $100,000 capital gain. I get 20% of my ordinary gain. Now I get a $40,000 deduction. Raised or purchased makes a difference. Makes a big difference on the deduction. Okay, so think that one through. And again, the slides are going to be made available to you, so you'll have these to consider later on. What about rental income? Is rental income business income? It depends. Even after reading 184 pages of regulations, I still can't answer that question. And that's one of the things I'm writing into the testimony that'll be presented to at the hearing on the regs in D.C. on October 16. IRS considers many rental activities to be non-business. Now, we can group, we can aggregate activities, but, and technically the deduction is not dependent on whether I'm materially participating in the rental activity. The question is whether the rental activity is a business activity in and of itself and I have an ownership interest in it. That's what the key is. But I still can't stand here and tell you for certain right now whether a cash lease income is business income or is not business income. We still don't know the answer to that question. There's some comments in the regs that seem to indicate, yes, you can treat passive rents as business income. However, they talk out of both sides of their mouth, and I'm still not sure because there's some other comments that indicate that that's passive and would not be business income. We can aggregate activities, and that's going to be helpful. In the interest of time, I'm not going to take you through the aggregation rules. But if we can group activities, a passive activity with a business activity, perhaps we can make the entire income, business income, subject to the deduction. Let's say in this example, Shorty operates a small animal feed manufacturing business as a sole proprietor, as well as a farming operation. His feed business had net income of $50,000. The farming operation had a $75,000 loss. His qualified business loss, you net those out, is $25,000. So he's $25,000 negative. So he can't get a cubit. You have to be positive. You have to have positive business income to get a cubit. So he doesn't get anything, and he's got a $25,000 qualified business loss that carries forward to the next year. So Shorty will need qualified business income of $25,000 at least the next year before his QBI will exceed zero. So that's, you have to net it out, carry it forward in order to compute your deduction for the next year. Okay, we'll skip that. Kind of talked about that already. Let's go to another example, and I only got a couple minutes, or about 5 minutes left, and then I'll stop here. Joel's a single farmer, has 2018 net farm income of $250,000. He paid wages of $50,000 and has $600,000 of what they call qualified property. Now I jumped forward here into a new concept. If you get above certain income levels, then the computations of this get much more complex. It's not just a straight 20%. We've got wages, W-2 wages that come into play. We have qualified property definition that comes into play. You know, your machinery and equipment, how much basis do you have in those? And we have to put those into another formula to compute our QBI. What are the thresholds where this starts to become much more complex? $157,500 on a single return, so somebody that's filing as a single person. $315,000 on married filing joint return. The $157,500 is then subject to a $50,000 phase-in range on these formulas. So at $207,500, that's another magic number. The $315,000 is subject to a $100,000 phase-in range. So at $415,000, then we're subject to another computation. So Joel has net farm income of $250,000. He's over the $157,500. He's also over the $207,500. Now he's got to worry about whether he paid W-2 wages to employees and or had qualified property during the year, which I have not defined and probably won't get a chance to. But in this instance, his deduction is going to be the lesser of 20% of $250,000, which is $50,000, or get this, the greater of, so it's the lesser of something or the greater of something, and this is just a garbled mess. 50% of his wages, he paid $50,000 of wages to employees, W-2 wages, so that's $25,000, or 25% of wages plus 2.5% of his adjusted basis in his property, and I'm assuming that's $600,000. So it's the lesser of $50,000 or the greater of 25 or 27. As a result of that, it's $27,500. That's how you compute his deduction. See how easy that is? Okay. If he also has a custom cutting business that had a $150,000 loss and $200,000 in non-business income, then it can get really messy. His cubit in that instance is the lesser of 20% of his business income, which would be $20,000, because now we take the $200,000 or the $150,000 loss. He had another $250,000. He nets out $100,000, so 20% of that's $20,000. His wages qualified property limit is $27,500 from the previous computation, so it's the lesser of $20,000 or $27,500, subject to an overall taxable income limit of $60,000. So he's now down to $20,000 on that one. So there are lots of other things that we could say with respect to this. The computations are quite complex. I think I've got a couple other, I'm not going to take time to walk you through that. I think I've laid this out enough where if you study the examples, you might be able to make some sense out of it. Now you can see why this is really a 4-hour presentation. But got a lot of stuff in there, farmers as well as livestock producers. The qubit deduction is going to be an interesting thing to have to deal with in the future. Let me see if I've got one or two more that I can show. Oh yeah, let's talk about the dairy situation. Does anybody here operate a dairy? Are there any dairymen here? They all went broke. Yeah, they're gone. Well, let me take an example here. Schedule F income, $140,000. Investment long-term gain of $60,000, $150,000 from the sale of purchased dairy cows that were fully depreciated. So your tentative taxable income is $350,000. Now you got an overall taxable income limit of $70,000 in this instance when you combine those numbers together. So your qubit is limited to 20% of $290,000. That's the $140,000 plus the $150,000 of your business income, which is $58,000. But if you would trade for new dairy cows, you'd recognize $150,000 of gain. But then you throw that on the depreciation schedule and you take 100% bonus, okay? And that's going to reduce ordinary income and SE tax as I showed in a previous example. So that might be how you do that in that instance to get a higher example. On the co-op rule, all I say is this: whatever you receive as a pass-through deduction from the co-op, you take it. Not subject to the wage limitation, not subject to the qualified property computation. Whatever passes through to you from a co-op, you can just take that. Now, does that mean it's always better to sell to a co-op than to a non-co-op? Given the change that occurred in March, the answer is no. It's going to depend on your particular situation as to whether it's better for you to sell to a co-op or not sell to a co-op. The answer, the way you answer the question is whether you pay wages to farm or ranch employees and whether you have qualified property. That's going to make the difference as to whether you sell to a co-op or whether you don't sell to a co-op. Okay. And these slides just sort out what the rules are in that situation. But the answer is it depends now. Under the original rule before it got amended, it always was more beneficial to sell to a co-op. And that's why the private elevators griped about that, and they came in and Congress modified the rule that took effect in late March. But this is the answer to how you make a determination as to where it's better to sell, whether to a co-op or to a non-co-op. Okay. They're just at the end of this, you're going to see there are just some basic planning points as to how you structure your operations to take advantage to the extent you can of the deduction. Okay, I think I'll leave that at that point right there, and I'll give you my contact information. Feel free to send an email anytime you have questions. I try to get to those as quickly as I possibly can. There's my website address, and if you're into Twitter, I'd encourage you to follow me on Twitter at WashburnWalter, and follow me on Twitter. I do put out a lot of information on Twitter as well as Facebook too. So you can follow me on Facebook. I use both Twitter and Facebook for educational purposes. So I guess, Tatum, I'll turn things back to you. And thank you very much again for the chance to talk tax with you this afternoon.